Hi believers, this is Amit from Waya team, and I'm here to provide a weekly bite and the road ahead in the markets. It was a choppy week, and the Indian stock market faced renewed selling pressure. The Nifty 50 ended the week with 0.58% decline, and the Bank Nifty dropped by quarter percent. Broader markets, however, outperformed the mid-cap and the small-cap indices, reporting gains of 1.7% and 1.5% respectively. Trump's tariff tantrum continues to be on top of mind for investors, and the street is confused regarding the sectors that are likely to get impacted and to what extent. For example, this week, Nifty Auto and Nifty Pharma indices were down by 2% and 2.1%. Auto was down due to tweak in the domestic EV policy by Government of India so as to pacify Mr. Trump's call for reduction in tariff and pursuant entry of large auto global majors like Tesla, BYD, etc., denting the market share of incumbents like M&M, Tata Motors. For pharma, likely tariff of 25% on the export of pharma products to US, and hence both these sectors were pretty much down. FIIs continue to be on the selling mode on the back of weakening and volatile USD INR. Another global factor that is at play is that Chinese government has taken a slew of fiscal and monetary policy announcements to consolidate the national growth at around 5% in the year 2025. The market believes that such stimulus packages may soften the blow expected from the tariff imposed by Donald Trump on China. Therefore, FIIs are moving money from India to China for higher returns. The Hang Seng Index hence shot by 18.7% in a month, in sharp contrast to 1.55% decline in the Nifty. Recently published lower than expected economic figures of the US economy suggest that President Donald Trump's policy may hurt US corporate activity, for which the US market fell sharply on Friday. Hence, we expect a ripple effect in India, making tomorrow start with a gap down. According to the S&P Global study, corporate activity in the US has drastically dropped, with growth slowing to a 17-month low. Specifically, the services sector had an unanticipated decrease. US Fed officials have also expressed concerns about the tariffs, which they believe could put upward pressure on prices. Duties on incoming goods to the US will raise domestic cost, forcing consumers to pay higher prices for the same products, potentially hindering the Fed's effort to bring inflation down to 2% target. Hence, markets in US will not go up very soon. Coming to the Indian economy and markets, which is very important for you to listen. Although the market has undergone a healthy correction, the uncertainties around the gradual recovery of corporate earnings and ongoing tariff-related risk continue to cast doubt on valuation levels, particularly in the broader market. India is currently lagging behind its Asian peers as FI outflows remains high. This week, the RBI also said it will conduct a USD INR buy-sell swap auction on Feb 28 to inject rupees 86,000 crore in the banking system. This is massive number aimed to improve liquidity in the Indian banking sector, which is getting impacted by FIs pulling out money. Before, the RBI also cut the repo rate for the first time in nearly 5 years in February. But without the sufficient cash in the banking system, rate cuts will not be effective implemented by the lenders. Given the pickup in the government spending, easing of liquidity conditions by RBI, boost to consumption expenditure provided by the budget, benefits of easing inflation and rate cuts, earning in FY26 are likely to grow in mid-teens and markets will start pricing them sooner or later. Valuations have become reasonable in many segments, and India remains a solid long-term growth opportunity in the global context. We believe FIIs are likely to start investing once again when the currency stabilizes and corporate starts to report good growth. What should we do as investors? We believe if a company is delivering on its revenue and profit targets, plus minus some small miss due to trade challenges, investors should stay invested, even if there's short-term volatility. Some stocks are just becoming cheaper due to forced selling by leverage investors or fund redemption pressures. But this should not deter long-term conviction. We at Waya always try to back up stocks with long-term earning growth prospects, and hence staying invested makes sense. along with adding them in tranches if they continue to deliver. If you're a long-term investor, try joining our PMS where we aspire 10x returns in next few years. Email us at the support email address with your phone number and we will get back to you if you would like to join our PMS. That's all for today. Thank you so much.